Welcome to another Market Insight Call, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this week is Chris. Why don't we just jump right into it? Last time that we were on, it was right before Jackson Hole. What happened in the market since then?
Yeah, so we've had a lot looking here. We're looking at the last 1 month candlesticks. So green days are up days, where you open at the bottom of the candle, close at the top. Red day, open at the top, close at the bottom. And then the wicks are the intraday high and lows. So we can see that high back in the 15th, 16th, bounced right off the 200-day moving average. That's that technical measure that a lot of people are placing orders right there to sell if you're not able to break out. Well, that happened, and the market did come back a few percent, 3-4%, kind of bottomed, and then had a couple 2 up days. And I don't know if you can spot the Jackson Hole speech on the chart.
I think it's that big red bar, right?
It's pretty obvious. Over a 3% down day. The market did not like what they heard from Powell. Continued to trend down since then, almost entirely down. Broke out below the 50-day moving average, which ended up being pretty tough resistance the past couple days. Those high wicks did bounce off of that number. A technician's not going to like the chart. You got the 50-day average moving down, 200-day average moving down. The RSI, which is a short-term oscillator on the bottom, moving down as well. It does tend to bounce off the 30-day, so if it can get a short-term bounce from some smaller up days, that basically means the market is getting too oversold as the measure reads. Maybe you'll start seeing some more technicians come in, but it's not a good chart.
No, from a technical standpoint. And we can see that prior to that big red drop, there was a nice green up day. So what was happening is the market expected the Fed to pivot, not to be hawkish, not to raise rates, but they came out of Jackson Hole like a hawk. And whenever we're looking at Powell, what he was saying is he needs to get inflation at a sustained period of below trend growth, meaning back to that 2% or below. And he's very aware of the softening labor market, and I think that's the reason the market expected to see a slowdown in rates. But that didn't happen, and he's acknowledging that he expects some pain for the households and small businesses. So they really came out with a very hawkish tone, while the market expected this pivot or some more accommodation.
Yeah, the market wanted to hear, something about the economy, long-term forecasting, something like that. Instead, they got short-term, 8-minute speech about inflation. And Powell knew what was going to happen with this speech. It was very intentional speech, and I think he did it because of this next chart, which is national financial conditions. So looking back at this, it's just a measure, and I like to pull measures from some of the other Fed banks, the regionals, because they're probably all looking at this together and talking about it. And the way this chart reads is 0 is a long-term average. So when you're at, that 0, you're either not really loose or tight. When we're below 0, which we were in January, conditions are loose. And as you start moving up higher, they're tightening. And then above 0, their conditions are actually very tight. And we can see the last 2 months, we've seen loosening in the system. So this is the market, mortgage rates dropping from 5.8 back down to 5 in this time period. And these measures are made up of 150 other measures that we talk about all the time, from yield spreads, high yield spreads, mortgage rates. The stock market is in here. Basically, the market was fighting Powell. They were going against what the Fed was saying, and they didn't like this. It does not help the fight against inflation when the system is getting looser. So he wanted to try to talk this down, try to get conditions to get a little bit tighter. I think that's why he delivered the speech.
Right. And these are relative rates, so it doesn't matter where the Fed funds rate is. It's how is it relative to the normal conditions. So when we see negative, that means that the spreads, where you can borrow high yield, maybe you're only getting 100, 200 basis points over the Fed fund rate, which means that the market doesn't see a recession.
Right.
Otherwise, those spreads would expand.
Right.
But let's
because the Fed's controlling the short end of the curve, right? They're raising the really short end and hoping the rest of the yields will respond. Now the long end was lower, right? They wanted to say, hey, if we're going to keep the short end higher for longer, the long end's going to need to come up too. Higher rates, higher borrowing costs, and that's really what they're trying to get.
So if we just remove the relative, which I think, as you said, Powell is saying that, well, the market is not seeing softening in the economy. I can go ahead and continue to increase rates because there's not a correction concern, at least in the market. But if we just look at rates, what is the Fed policy, not how are rates relative to the Fed policy. We can see that we certainly are in a tightening phase, and everyone knows that. That's the reason the market sold off on Jackson Hole, and we're at levels that are fairly high, and often, so let's say the lower level where recessions happen. It certainly can go higher. We've seen that historically, but anytime that line is going above the line, that's tightening conditions. And then we can see other times that the Fed is going below the line. That's a loosening or accommodative Fed. So we're certainly at risk of a recession whenever we look at where rates are from the Fed. But to your point, they're looking at relative rates. And then if we continue to look at just data, we look at what are the total assets on the balance sheet. So there's a lot of quantitative easing, quantitative tightening in headlines. What does that mean? It means the Fed is buying bonds. That's quantitative easing. They're injecting money by purchasing those bonds. And then quantitative tightening is just letting those bonds mature. We can see that they have been doing that for several months now.
That's the blue line.
That's the
and
blue line.
And the red
right?
line's
So
the S&P 500,
so you see that
stocks reaction.
It had peaked and now it's starting to come down. And there's certainly a correlation with how the S&P 500, that red line is, as the market was, or as they were doing the quantitative tightening before, we started to see the S&P really start to move and change. Now there still is a big pop before COVID, but there's a lot of tax cuts that drove earnings up that was explaining that. And then the Fed became accommodative. And I don't know if people remember during COVID, through that market correction, which was severe and fast, we looked at this money supply and said, it's a V-shaped recovery because the amount of money that was created. So we see this as a very important indicator to pay attention to. So as the Fed continues to tighten here, we're concerned about the market, and we look at the money supply, just another way that we measure it. Anytime we see a slow growth, which is the green line, what we're looking at, we're concerned. Well, it's not a slow growth, it's actually a detraction because we're seeing the money supply contract or get smaller because of quantitative tightening. And we're in a seasonal low. That's what that yellow line is indicating. We tend to see it start to move back up. We've yet to see that. So we're pretty concerned about where markets are whenever we look at this indicator. Other things that say it's not too bad. But a lot of those good news things that could drive the market, there's becoming fewer and fewer of them as we go on.
I wanted to point something out on the last slide too. The early period, 2018, 2019, where we do see the balance sheet coming down and the market was stabilized. And because it's similar to what we're going to potentially see here now, right? The market, the balance sheet is coming down with them rolling off their bonds, and they're really starting to roll them off this month more than the prior 3 months. But the money supply was growing, right? They can contract the money supply with their bond purchases, but as long as banks are lending, credit's expanding, which is what happened in 2018 to 2019, you still had M2 growth, right? So that's what you're measuring with the second measure, which is to say, no, M2 is still coming down with both systems of measuring it, both the Fed balance sheet and credit from the banks.
Absolutely. So then one thing that's getting hit because of higher interest rates is the housing market. And this slide is just looking at what is the principal plus interest payment on the average home that you're purchasing. And we can see that it was very stable. Obviously, the West Coast always will move, as well as some of the East Coast or Northeast Coast because of just prices. But if we look at what's happened now that interest rates have moved up, what was costing you $600 or $800 a month in 2020 is now costing you $1,300 in the Midwest. If you're in the West Coast, it's gone from probably about $1,800 to $2,900. So a doubling to $1,000 extra. No change in the home other than what you're paying for the principal and interest. I guess there has been a slight increase in home values as well. So this is really starting to slow the housing market. And another chart, this by the way comes from Wisdom Tree's equity manager, Jeff Weinger, on Twitter. If you had a $500,000 house and you had $250,000 as a mortgage, $250,000 of equity, and you're paying 3%, your mortgage is about $1,000 a month. And now if you're wanting to sell that house and buy a new one, let's just say you're just making an equal trade. You want to go to another $500,000 home. It's going to cost you not $1,000 but $1,400. And remember, that's with a $250,000 mortgage. So if you have higher mortgage, this change is more pronounced. And then if you want to upgrade, go to $700,000, well, you're going to go from $1,000 to $2,500 a month. So this is going to put a lot of headwinds on the housing market as we change them. We had a few months ago clients asking, should they purchase a house with home values as high as they are? And we said, well, if you want to stay there and you like it, yes, because though prices in homes may come down, which they would need to help make this adjustment, the cost of interest rate or your mortgage, what you pay on a monthly basis, it may be better to overpay for the home and have a lower mortgage payment because of the interest than what we could see coming up. And I think that so far has been proven true. And we're seeing that impact in the housing market. Builders are not building as many houses. So there's still a long way to go in the housing market, not calling for a crash by any means, but there's a lot. Prices have to come down, interest rates have to come down to make it easy and feasible for people to make a change. Otherwise, they're going to just push that off.
Significant part of the CPI, right? Not actual housing prices. They consider that an investment, but it is part of owner's equivalent rent. So it's something they're trying to bring down or at least get to stabilize.
Another thing where interest rates have a major impact is just the federal budget. So this slide, I know there's a lot of numbers here. The left side are outlays, what we're spending. So we expect to spend $5.7 trillion in 2022. We'll bring in receipts for about $4 trillion in taxes. So right off, we have a deficit of about $1.7 trillion. But let's remove the discretionary. So that's defense spending and non-defense, that's discretionary. It's not written in law that these have to be paid. There's still some wiggle room there. And then we just look at the mandatory, Social Security, Medicare, and Medicaid, other things that are legally required for the government to support, as well as their interest payments on their bonds. Now, we have a $30+ trillion national debt, and they're paying $305 billion in income. Or interest. That means there's an average interest rate cost for the government of about 1%. That's not a big impact. And if we looked at how long are those bond maturities, they're at about 65 months. Let's say that's 5 years. So that's 1% for the whole 30 trillion. Right now, a 5-year bond is trading at 3.4%. And if we just wait and stay at these rates, the maturities are going to roll off, and we're going to replace them with more expensive bonds. So if we get to 3.4, 3.5 on a 30-year, $30 trillion debt, that's going to be well over $1 trillion in interest. And once again, let's just look at that mandatory spending. We'll be at a deficit of $1 trillion before we've written a check for anything that's non-discretionary, any defense. So the Fed, as much as there's issues in the mortgage industry, if interest rates were to go this high, how are you going to pay for them? Because you can't tax. It would take a 43% increase in the receipts just to cover that deficit to say, okay, we're finally neutral. We're not adding the debt. Because every dollar that you add increases the interest payment. So what I think the long-term play here by the Fed, and I know in Jackson Hole, Powell said he wants to fight inflation. And I think they do want to fight inflation, but not so much to bring it down below 2%. What I think they're desiring is that GDP, because of inflation, is growing at a faster rate than what they're paying in interest, so they can basically inflate a lot of this debt load away. Because if they were to try to raise taxes, that's going to take it out of GDP and is going to compound the problem. So there's really basically one option they have, which is to try to let inflation remain above interest rates going forward. So that's one of the reasons that we've been hesitant to add a lot of fixed income or bond exposure, because we think interest rates are going to be below that inflation rate, and we're going to see anyone that holds that $30 trillion portfolio lose some of their purchasing power over time.
Right. A lot. Oh, there's a lot there.
There is a lot there.
Yeah, and we have been adding some fixed income. The short end, right? This is things that are maturing very soon, so you don't have a lot of that price volatility that you're talking about if rates do increase.
And we want to get into some of our trades, but why don't you go over the labor market, which is another part that they were talking about out of Jackson.
There's not a whole lot of market moving activities from here on the next couple weeks, but this was one that came out on Friday, and we still are in that system where bad news is good news, where the market wants to see fewer jobs added, some jobs added, but not too many, because then the economy's overheated and the Fed has to keep fighting. Well, they had over 300,000 jobs added with the non-farm payrolls. That's that bottom green bars. pretty, coming down, so a good sign, but 315 was pretty high. Market was hoping for more like 100,000. We still got it in the other, over 170,000 in the household survey. Those are the two surveys we've talked about in the past that have had some divergence the last few months. The unemployment rate did go up 0.2% from 3.5 to 3.7. So the market did kind of like to see that. They were happy to see that, the Fed's been saying around that 4%, 4.5% would like to see unemployment kind of help them out when it comes to inflation. So get that elevated a little bit. And that was from labor force participation. So the top left chart we're looking at here, the participation rate increased. So nothing substantial, just back to where we were several months ago, but moving in the right direction. And then the top right is average hourly earnings coming down a little bit too. So coming back in the 5.7 range. So there was some good news and some bad news from the report.
And since employment is basically at the level it was prior to 2020, you're probably not going to see big numbers from here, right? We're basically at full employment, so you're not going to see a lot of upside. The only way that you would see a big change is if we were moving into a deeper, more pronounced recession, where all of a sudden unemployment changes. So
yeah, this was the first number that did put us back above the 2020 high. I think we're about 240,000 jobs above where we were.
So we're
in
finally
February.
really at an actual net gain in jobs at this point. So what about some changes that we're making in the portfolios? We've got a little bit of bearish here out of the Jackson Hole announcement.
We reduced a little bit of volatility. We had a couple volatile positions and a couple qualified accounts, brought those to core, and we did add some short-term treasuries, floating rate treasuries, really just trying to get the yield on the Fed funds rate, just some short-term stability.
Right, so that rally coming out of right before Jackson Hole hitting that 200-day, we had added a lot of growth stocks because they were working. And as you pointed, we're kind of going back to more of a neutral stance. We've added more U.S. large cap. When we look out internationally, especially in Europe, it's just not attractive at the moment with the amount of risk that you're taking versus what you're going to get as return. So we've definitely have increased our U.S. large cap, and to your point, we've taken some of our gains and moved them into a fixed income fund, but to your point, it looks more like cash than it does bonds. So we are becoming more defensive, and a lot of it is we're getting sell signals, but there's really not that much left that's attractive on the buy side. So we need to see this market begin to move, have a breakout before we could, based on our process, start adding some risk in there, or we are becoming defensive because maybe the market is coming into a more volatile phase. So know that we are watching. We are becoming a little bit more defensive in the portfolios. Obviously, if we had a sharp rally, we would lag, but it's been adding value for us, and we expect the wisdom of not fighting the Fed to be true. You don't want to fight the Fed here, but then inflation says don't go all cash either. Right. Any other comments before we?
We're going to see inflation reading. We've only had one since inflation has been coming down, so we get that on Tuesday, the 13th. So that's going to be a market moving number, and then from there, the next thing is the Fed meeting on the 20th, and then the conference on the 21st. We'll hear if they go 50 or 75 basis points. It's most likely going to be 75. It just wouldn't make any sense to deliver that speech 2 weeks ago and then to come back and only raise rates by 50 basis points. It just doesn't make any sense. So we're expecting 75. Market's at about 80% chance of that.
Right, and I would expect the CPI to basically be very similar to the previous month. We haven't seen big movements in fuel prices since then. That's really what drove a lot of that cooling down last month. So it seems that things are pretty much stable at the moment, but let's see what the monthly print looks like coming up soon. We really appreciate you tuning in. If you haven't subscribed yet, hit that subscribe button. Make sure that you hit that share button to share with your friends. And if you enjoy the sign back up with all its blues, go ahead and hit that like button, and we will see you in 2 weeks. Thank you.